He said FDIC insured. 3.5 million people believed him. Then Three Arrows Capital collapsed, and the FDIC insurance meant almost nothing.
He was a Wall Street veteran. He told investors their money was FDIC insured. He told them Voyager was different. 3.5 million people believed him. Then Three Arrows Capital took $650 million, and Voyager had nothing left. This is Voyager Digital. He was not a crypto dreamer. He was a seasoned Wall Street veteran. He had spent decades in traditional finance. He had credibility, experience, and a track record. He told ordinary investors that Voyager Digital was different from other crypto platforms. He told them it was FDIC insured. He told them their cash deposits were protected by the Federal Deposit Insurance Corporation, the same protection that covers money in traditional American bank accounts. There was just one problem. It was not true. The FDIC does not insure cryptocurrency, and the cash deposits at Voyager, while technically held at a partner bank, were not protected in the way Ehrlich implied. When Voyager filed for bankruptcy in July 2022, 3.5 million customers found out what FDIC insurance actually meant for their Voyager accounts. Almost nothing. This is Voyager Digital, and this is the story of how Wall Street credibility and misleading marketing combined with catastrophic exposure to Three Arrows Capital to destroy one of the most trusted names in retail crypto. Stephen Ehrlich co-founded Voyager Digital. In 2018, his background was impeccable. He had been CEO of Lightspeed Financial. He had worked at E-Trade. He had decades of experience in regulated finance. This was his selling point. Voyager was not a reckless crypto startup. Voyager was regulated, serious, trustworthy. It was listed on a public stock exchange in Canada. It had raised hundreds of millions of dollars from institutional investors, ordinary Americans, many of whom were nervous about cryptocurrency but interested in the potential, were attracted to Voyager precisely because it looked like a real company run by a real executive with real credentials. The product was a commission-free crypto trading app, simple, clean, accessible. Voyager also offered yield products, interest-bearing accounts where customers could earn returns on their cryptocurrency holdings. By 2021, Voyager had over 3 million customers. It was processing billions in monthly volume. It was one of the most downloaded financial apps in America, and it was deeply, catastrophically exposed to Three Arrows Capital. Three Arrows Capital, the Singapore hedge fund run by Suju and Kyle Davies, had borrowed $650 million from Voyager Digital. $650 million. This was not a small position. It was not a diversified portfolio. It was a single massive loan to a single borrower, representing a significant portion of Voyager's total assets. When Three Arrows Capital collapsed in June 2022, unable to repay its debts after the Terra Luna crash, Voyager was left with a $650 million hole in its balance sheet, a hole it could not fill. There had been warning signs. Three Arrows Capital had missed margin calls with multiple counterparties. Before the extent of its collapse became public, Voyager had not moved quickly enough to liquidate the Three Arrows collateral. The time it tried, the collateral had lost too much value to cover the loan. On July 1, 2022, Voyager issued a notice of default to Three Arrows Capital. On July 5, 2022, Voyager Digital filed for bankruptcy. 3.5 million customers were locked out of their accounts, approximately $1.3 billion in cryptocurrency and cash frozen. The marketing that had attracted many of those customers, the implication that their deposits were FDIC insured, was later cited by regulators and courts as misleading. The Federal Trade Commission and the Federal Deposit Insurance Corporation had both sent letters to Voyager in 2022 warning that its marketing materials were false and misleading. Voyager had continued using them after filing for bankruptcy. Voyager attempted multiple rescue deals. First, a deal with FTX. Sam Bankman-Fried, in his days of apparent wealth, offered to acquire Voyager's assets through FTX US. The deal was announced in July 2022 before 2 months later, Sam Bankman-Fried's own empire collapsed. FTX filed for bankruptcy in November 2022. The Voyager FTX deal died with its second, a deal with Binance US. Binance US agreed to acquire Voyager's assets for approximately $1 billion. The deal was announced in December 2022. Then, In April 2023, Binance US withdrew from the deal citing a hostile regulatory environment in the US. The deal died. Voyager eventually wound down and began returning funds to customers through its own bankruptcy. Process customers eventually received approximately 36 cents on every dollar. They had deposited 64 cents of every dollar. Gone. Stephen Ehrlich, Voyager's CEO, faced regulatory action. The Commodity Futures Trading Commission charged Ehrlich and Voyager with operating an unregistered futures commission merchant and making false and misleading statements to customers. In August 2024, Ehrlich agreed to a settlement and was banned from registering with the CFTC for 12 months. Was not criminally charged. So what is the real lesson of Voyager? Digital Voyager is a story about the weaponization of credibility. Stephen Ehrlich's Wall Street background, his decades of experience, his regulated company structure, these were not just qualifications, they were marketing tools. They were used to attract exactly the kind of investors who would not have trusted a crypto startup, but who trusted someone who looked like them, spoke their language, and came from the world they understood. And when Voyager made promises about FDIC insurance, those promises worked because they came from someone who sounded like he knew what FDIC meant. The lesson of Voyager is not just about due diligence, it is about the difference between the appearance of regulation and actual regulation, between the appearance of safety and actual safety, between a credential and what that credential actually guarantees. In a world where financial products are marketed like consumer goods, the most dangerous lie is the one that sounds the most familiar. That is the capital case. Subscribe to the capital case because the next case is already waiting.